Good morning, afternoon, and probably evening, depending on your workstation. I'm Kamiri Tafak, financial sector lead within the Secretary of Making Finance of Africa, and it is my distinct privilege to welcome all the participants to this webinar we are co-hosting with the European Investment Bank on the last edition of the Africa Finance report on the topic Uncertain Time, Resilient Bank and Africa Finance at the Crossroads. We are in fact meeting at a time when the global economy is still navigating the consequence of the recent consecutive crisis, mainly the COVID pandemic and the prolonged conflict in Eastern Europe. The global economic recovery remains slow, although with striking regional disparity. African economy, for instance, continue to demonstrate remarkable resilience despite significant headwind, and the outlook remains positive. If I quote here the last edition of the Africa Economic Outlook released by the African Development Bank. The growth rate is projected at 4% in 2023 this year, and probably it will pick up at a higher level next year. Having said that, we need to acknowledge that the theme of this webinar is timely, as we will reflect on the role of the African financial finance in sustaining the current economic recovery and the growth momentum. The report that was published last year, and which is based on surveys of African banks, which actually happened conducted by the EIB and Making Finance of Africa every year, actually shed light on how finance can accelerate this trend on the continent. The continent is actually increasingly connected to the global financial system. Bond market and private capital market are vibrant and growing, although in some places the capital market are still at a very nascent stage, but the dynamic is there. We also notice as among major trends, the fintech boom, with fintech playing a more, increasingly playing a transformative role on the continent. A lot of services in different sectors are now delivered by the fintech. Regulation and supervision has been improving based on fintech's instruments that are provided. So clearly, there's a new dynamic, and there are also a new concern with the financial sector in continent that are little like the green finance, how to adapt to all the climate change agenda, and so on. And we are sure that today, the webinar will provide a clear opportunity to discuss how the financial sector can actually invigorate the sustainable development and structural transformation of our economy. I'm sure that some of these questions will be clearly addressed by our panel through the panel discussion that we'll have today. We have very the panelists are really have the background expertise that they require really to carry us through this the subject and go a bit in depth. Before we dwell into the topic, let me quickly share some practical question with you. Can you go back to the previous slide on how the webinar will unfold? We'll have it for 75 minutes, including Q&A. And for the better comfort of all the participants, all microphones will be put on muted. If you have questions, please try to submit them through the Q&A panel. And the slide and the recording will be made available 72 hours after we complete the webinar. We also invite you to send your questions to the organizer, in particular technical. If you encounter some technical problem, send just a question and we'll try to help you. And finally, at the end of the webinar, you have a questionnaire that will appear automatically. We invite you to answer the questionnaire because we really value your feedback. It helps us actually to improve the delivery of our future webinars. On that, I will now invite our moderator of today to take the floor. The moderator of this session will be Mr. Ricardo Santos from the EIB. Ricardo is an economist in the country and financial sector analysis division of the EIB. He covers a wide range of macroeconomic and financial sector development issues with a strong focus on Africa regions. Ricardo has been involved in previous editions of this report, so he has a very comprehensive view of the financial sector on the continent. I think Ricardo will have also the role to introduce our eminent panelists of today, including the presenter, Mr. Colin Begeman. Ricardo, you have the floor. Thank you.
Thank you very much, Hugh, and good morning, good afternoon, or good evening to all the participants. Now, I'll just be quite brief now in this first, part, before introducing then the panelists on the second panel. I'll just, pass the floor to Colin Birmingham, so my colleague in the economics department that has been leading the Finance in Africa publication and the survey for the past couple of years. And well, you'll be basically presenting you all the main conclusions from this year edition of the publication, and then we'll follow up with a panel discussion with our distinguished guests. So, Colin, the floor is yours.
Thanks, Ricardo, and thanks also to our colleagues at Making Finance Work for Africa for their ongoing collaboration with the port and with the organization of this webinar. So, as mentioned, one of my main work streams here at the European Investment Bank is working on the Finance in Africa report. We've recently published the 2023 edition. Next slide, please. And in the 2023 edition of the report, we have 6 chapters. And sorry, next slide, please. And in the report, the chapters are covering things like the banking sector, digitalization, climate finance, gender lending. I'll try to give you a quick, view of the highlights of the report today. And in any of the slides where I'm kind of mentioning results from our survey, this is a survey we do every year. So this year we had 33 banks in sub-Saharan Africa respond to the survey. And the survey was carried out between March and April of this year. Next slide, please. So one of the things that we try to do at the beginning is try to understand the condition that private sector operators like banks and firms are facing, the kind of financial conditions that they're facing in Africa, particularly in light of the events of the last couple of years. So we created a financial conditions index for Africa, beginning by first creating country indices for Nigeria, South Africa, Egypt, and Kenya, and then aggregating them to come up with with an overall index. The types of variables that we include in the index are things like credit growth rates to public-private sector, lending spreads, changes in policy rate, the inflation rate, the exchange rate, stock prices. And we condensed this, like I said, into a single financial conditions index, which you see in the chart on the left. It's the brown line there. And basically, when that brown line is going up, financial conditions are improving or they're loosening, and when the brown line is going down, the financial conditions are they're tightening or getting more difficult. Generally, what we see since the period right after the global financial crisis in 2008, so from 2009, we see, I would say, 4 distinct kind of loosening periods and 4 distinct tightening periods. In general, it seems that the loosening periods are a bit more rapid and the tightening periods tend to last a little bit longer. I think what's interesting is if we look at the period immediately after the onset of the pandemic, it didn't immediately lead to protracted tightening in financial conditions, because at least initially central banks were still, their response was to ease policy rates. It took a while for inflation to increase, and stock markets showed some resilience. But particularly after the outbreak of war in Ukraine and the subsequent additional kind of boost to inflation, that led to a very kind of synchronized tightening in global monetary policy, which was also seen in Africa, and a lot of African countries saw weakness in their exchange rate. So we saw this kind of distinct tightening in financial conditions. And I think if we look at the countries in the index, we know that like the chart here is only covering the period up until the first quarter of this year. But as we extend that, we know that the tightening is going to continue because we've seen continued high inflation in some of these countries. We're also seeing further exchange rate weakness. So I think we're going to see a very distinct continued tightening in financial conditions. And for the 2024 edition of the report next year, our plan is to bring in some extra 3 or 4 countries to kind of further broaden the representation of the index. Next slide, please. Another thing we try to get a handle on is the degree to which bank lending to the public sector, to the government, is crowding out or restricting the availability to the private sector. So we can see from the kind of the chart on the left there, which shows bank claims to central government as a percentage of bank assets, that there's quite a lot of countries where the share of government lending is higher than 20% of total assets for the banks. I think there's around 20 countries that fall into that category. And what's more, I think this is often happening in countries where the sovereign debt is considered more risky. So more risky in the sense that if they have bond market access, then yields are at quite a wide spread to equivalent US Treasuries, or if they don't have market access, they're classified at high risk of debt distress or in debt distress by the IMF. So we've also created an index to try and capture this. So the index has about 10 or 12 indicators across 3 broad categories. One category is looking at the public debt, so the availability of public debt, the yields on public debt. There's another category looking at private sector, so mainly in terms of like private sector credit demand. And then we have a third category, which is kind of looking at banking sector, the banking sector's level of development and interest rate spreads. And if you look at the chart on the right, so the kind of the black line there is our SOCO, which is Severity of Crowding Out Index for Africa on average. And what we saw was that in 2019, immediately before the pandemic, crowding out pressures were relatively low. But we got an increase in 2020 because there was a big increase in public debt issuance, which was obviously to support economies, and banks had to support some of that and buy some of that public debt issuance. And then there was kind of a continued upward creep in the index over the next couple of years, which was more linked to a rebound in private sector credit demand, which was competing with this public sector credit. But there is a broad spectrum of, there is a broad range of measures or like severity across the different countries. So you can see that crowding out pressures are, say, weakest in North Africa and strongest in East Africa. Next slide, please. But despite this quite, say, challenging, macro financial background, one thing we're seeing for sure is that, banking sector metrics look resilient across regions and across, some key metrics. So, for example, the numbers in the table, I'm not going to go into them in detail. They generally speaking refer to 2022, and where you have a green arrow, the measure has improved relative to 2021, and where there's a red arrow, it has disimproved. What we're generally seeing is, better profitability across the regions. We're generally seeing better, improved capital ratios. We're seeing a little bit of a mixed picture in terms of non-performing loans. But I would say even in the regions where non-performing loans have increased, they haven't increased that much, or at least certainly not as much as would have been feared at the outset of the pandemic. Next slide, please. So we asked banks what are their main concerns in the, sorry, just go back one, please. We asked banks what are their main concerns in the year ahead. When we asked this in 2021, asset quality was the biggest concern that banks had in the period immediately after the pandemic. It's still an issue. We still have 47% of banks referencing it. It's the kind of the third largest factor now. When we conducted the survey last year in 2022, local currency funding costs became the number one issue. And that was against a background of, I guess, central banks aggressively raising domestic policy rates. Still an issue in 2023, but it's now the second most important issue. And the issue which really came to the fore this year, without really featuring much in previous years, was the cost or availability of foreign currency funding, cited by 69% of banks. And I think it's kind of reflecting the hard currency funding squeeze that's facing African sovereigns as well. At the lower end of the rating scale, we've seen almost no issuance from these sovereigns over the last 18 months. I think these funding issues are extending to the banking sector. So banks which have maybe large foreign currency liabilities that need to be rolled over, it's not so easy to do that anymore. Next slide, please. One of the good news stories for sure for the banking sector, I think, is profitability. 80% of the banks in our survey this year are saying that they expect profits to be higher in 2023 rather than 2022. We asked banks what the main profit drivers are. You can see that in the chart on the left there. So in terms of the factors driving profits higher, these are the kind of the brown portions of the bar. And what it's showing us is that about 80% of banks are citing, improved interest income and growing business volumes as significant profit drivers. In terms of factors which are weighing on profitability, for some banks, there's still issues in relation to asset quality and impairment, but it's by no means universal because it's another cohort of banks who are seeing improvement on that front. And the other factor weighing on the profitability is staff costs. The next thing we're asking banks is how credit standards have changed and will change. So the chart on the right there, so the first bar, the one for the past 12 months, that's showing that credit standards tightened for a third year in a row in 2022. With a net tightening of 13% of banks. Now, what we mean by a net tightening is, so for example, I think there were 33% of banks, roughly speaking, who had some form of tightening compared to 20% of banks that had some form of loosening. So if you take the 20 from the 33, that's kind of a net tightening of 13% of banks. And when we asked banks what they were expecting to do in the year ahead, there was an even more severe tightening expected, a net tightening of 31% of banks. And I think that's probably reflecting, the kind of the high interest rate environment, some of the kind of challenges that we saw earlier. But I would stress that what was coming through clearly as well is that there is a very clear appetite still amongst banks to continue with their lending activities and to grow their loan books. But I think they're exercising a degree of caution in terms of the underwriting standards that are being applied to the loans. Next slide, please. We ask about digitalization in our survey. It's now a core offering of banks, digital service. I think something in the region of 80 or 90% of banks are saying that they are, realigning their internal structures in order to better suit the delivery of digital services. We asked banks what sort of digital services they currently provide. That's in the chart on the left. Again, the brown bars are showing the percentage of banks that offer a listed service digitally. If you look at the first three rows there, you can see about 80% of banks are offering, standard services digitally, things like transferring money, paying bills, receiving money, paying for things in shops. If you go to the bottom of that particular chart, you can see that when it comes to more complex processes like opening an account, restructuring a loan, applying for a credit card, the share of banks offering these services digitally drops to about 40%. But what I would say is if we look back over our survey over the last couple of years, this 40% is an improvement on what we'd have seen in recent years. So there is progress even amongst these more complex processes. We also asked banks what are their barriers to doing more in terms of digitalization. Lack of funding, I think, is a big one. You know, it's probably the issue listed most frequently as a severe constraint. And that's followed then by cybersecurity, because obviously as you migrate more services digitally, cybersecurity becomes a bigger concern and a bigger challenge. The third factor, particularly if you consider the banks that listed as a moderate constraint and not just a severe or major constraint, is competition from telecom and fintech. And I think this kind of relationship between banks and fintechs is, quite a kind of a complex and context-specific one, because we also ask our banks in the survey how many of them have partnered with fintechs or invested in fintechs, and actually quite a lot of them have. So I think this is kind of quite a complex and evolving relationship. Next slide, please. So we also have a chapter on gender in the report, which is based on enterprise survey data for 19 countries in Africa. What we find is that amongst the surveyed enterprises in these particular countries, 29% of the workforce is female, and a third have female leaders. What comes through is that female leadership is good for female employment. So, for example, amongst female-led firms, the share of female employment is 41% compared to 23% for male-led firms. You can see that in the very bottom left of the chart over there for SSA, for sub-Saharan Africa. That shows you the gap between male and female employment, the gap in female employment in male versus female-led firms. And what I would say, particularly if you compare sub-Saharan Africa to other regions, so we compare it to the EU and the Western Balkans, Eastern Europe, Central Asia, the type of gap we see between female employment between male-led firms and female-led firms in sub-Saharan Africa is very much typical of what you would see in other regions. So what we're observing here in sub-Saharan Africa is not different to what we observe elsewhere. Next chart, please. We also try to delve a bit deeper and understand the characteristics of female-led firms. And what we find is that better managed firms are more likely to be female-led. So, for example, we categorize firms into different management qualities, so low, medium, and high. And the chart on the left there is showing that the percentage of female-led firms is higher in the high quality management index. Now, what do we mean by that, by the high management quality? Well, if you look at the chart on the right, what it's saying is that female-led firms are more likely to be engaged in innovation. They're more likely to be engaged in exporting. They're more likely to be involved in training their staff. We also look at other metrics in the report. So there's several indicators across which female-led firms are outperforming male-led firms. Next slide, please. What we also find, we try to figure out how female-led firms and male-led firms, reacted to how they were impacted to the pandemic and how they performed. And without going into too much detail, because I can see that the time is already getting short, but generally speaking, female-led firms were, I think, they were impacted a little bit more, severely by the pandemic. We had slightly higher rates of sales loss, slightly higher rates of liquidity problems. And the chart on the left in terms of sales loss is only recording whether there was actually a loss in sales and not the amount of the loss of sales. And I think if we looked at the amount of the loss in sales, we'd see probably an even bigger difference, because we know female-led firms were concentrated in the kind of industries which were hard hit by the pandemic. Yet even having said that, even by being a little bit harder hit, their performance was again slightly better. So there were lower levels of bankruptcy compared to male firms and slightly lower levels of permanent closures. The differences weren't stark, but I think you can kind of again see evidence of better management performance, through this data. Next slide, please. So the final issue I'm going to cover today is climate. So we tried to figure out in our climate chapter what's the level of climate risk on bank balance sheets. So we look at a few different sectors. So we look at the household sector, the sovereign sector, and the industry sector. We're basically looking at bank lending to these sectors. The industry sector is kind of then subcategorized into 7 individual industries. And for these different sectors, we have measures of physical climate risk and transition risk. We basically have scores. So for the household and for the sovereign sector, these scores come from the EIB country climate risk scores. There's a working paper on that available on our website. And then for the industry, we have physical and transition risk scores for the 7 different industries. So what we do is we take these scores and then we weight them according to the amount of bank lending to each sector. So the amount of bank lending to the household sector as a percentage, say, of the overall bank lending exposure to the economy. We also have some other additional methodological steps, but this is the kind of the broad way we go about it. Next slide, please. Yes, yes. So this is showing our banking sector physical climate risk scores on the left and transition climate risk scores on the right. So these scores can vary between 0 and 5, 5 being the riskiest and 0 being the least risky. And I would say there's 2 or 3 takeaways from these charts. Firstly, physical risk is a much bigger issue for banks. If you look at the chart on the left for physical risk, you have 13 countries where the banking risk score is above 3, compared to just 1 for transition risk on the right. And I think that's not surprising given that Africa is still a low emission continent. Secondly, if you look at the physical climate risk scores on the left, the scores are, I would say, bunched geographically. So the countries with the highest risk scores tend to be in West Africa and the ones with the lowest in Southern Africa. And that kind of reflects our EIB country climate risk scores where, first of all, sub-Saharan Africa is the region globally most exposed to physical climate risk. And within the sub-Saharan African regions, West Africa is most exposed and Southern Africa least exposed. And probably the third takeaway is that most of the exposure is coming through the industrial sector and the sovereign sector, with a relatively limited role to play for the household sector. And my final slide, staying on climate. When we look at the banks in our survey, I think they're really becoming invested in climate. Nearly 60% with a climate change strategy, and about 2/3 of banks considering climate in some fashion in the underwriting process. And we know that banks want to do more in terms of green lending, so we ask them, what are the barriers? What are the factors constraining green lending? And we give them 3 options, which are kind of related to supply side or to their own kind of banking side issues. And these options are that the banks lack enough long-term capital, that there's a higher risk or perceived risk for green projects, or that the banks themselves lack technical skills in order to originate more green lending. The options we give them on the firm side is that firms aren't interested in climate, or else firms are interested in climate, but they're not aware of green finance products. Or thirdly, that firms lack the technical skills to bring a credible green loan proposal to the banks. We find that it's a really multifaceted problem in the sense that for all 6 of these barriers, at least 30% of banks cite them as a major barrier. Probably the 2 coming through the most clearly, though, would be that clients are lacking the technical skills, or that the bank has insufficient long-term capital. And I think that's something where development banks and IFIs like us have a role to play. So I'll just go to the final slide to thank you for your attention. My email address is there if anyone would to get in contact. I would really like to thank the banks that took part in the survey this year. We'll be doing a new survey next year, which we will hopefully shorten and make a little bit easier for the banks to respond. And any banks that do take part, we would really, really appreciate that. Thank you.
Thank you, Colin. And just to remind everyone attending the webinar that we'll have some room for questions and answers for discussion in the end, also for Colin's presentation. So now let's pass to the next step of our webinar today. We're going to have what I hope is going to be a live with an interesting discussion with 3 distinguished guests. And I'll just do a short introduction. So we have Demba Tandia from TCX, is Vice President at TCX. And for those of you that don't know, TCX is a fund, which is a global initiative that whose objective is to offer long-term currency swaps and forwards. So basically to hedge FX risks to as many financial market players in emerging markets as possible. We also have Mr. Matu Mugu, Deputy Director in Bank Supervision at the Central Bank of Kenya. And then also Mr. Edu Amenove, Director of the West Africa Stock Exchange. In this panel, my idea would be then to first go through a first round of questions to our panelists, and then to close with a second round with some more follow-up questions or more or give them also some room for raising other points that you think could be interesting from the interventions of the ones that precede you. So my first questions would be for Mr. Demba Tandia, from TCX, and this will be, related to some of the, of the issues that Colin was mentioning, right? I mean, one of the challenges that many emerging and developing countries are facing is, the impact of the normalization of monetary policy in the developed markets and mostly in the US. But so in this case, I mean, for TCX, I mean, you are a provider of hedging opportunities for local currency in frontier markets. I mean, can you explain, I mean, for those that, I mean, are not familiar, probably not that many that are joining this call, what is basically your business model and what have you been, witnessing over the past couple of years? I mean, basically since the monetary normalization started. And then also, I mean, you've been recently publishing some research on currency risk management with Making Finance Work for All as well. And there was something more specifically on reviewing the financing of green energy projects in Africa. Can you also share some of the insights of these publications? I mean, so basically to give us the idea of, what TCX does in practice and what is the challenges, but then also, what are you finding on your more research work streams?
So thank you very much, Ricardo. Just doing a test to see that if you can hear me. Is it fine?
Loud and clear from my side, yes. I guess from everyone as well.
Excellent. So thank you very much. So good afternoon from Amsterdam and good morning or good evening for all the participants, depending on where you are. So it's a pleasure to be invited. So, and thank you very much, Ricardo, to giving us the opportunity on behalf of TCX to answer some of the question you raised, which are relevant specifically nowadays, knowing the challenges that the continent, but also I will say the globe is facing, generally speaking. To answer your first question, for those who don't know TCX and who have never heard about our fund, so to make it brief, we are a development finance institution initiative. So our shareholders include a lot of MDBs, so multilateral development banks, TFIs, some impact investors. And thank you very much for the European Investment Bank to being one of them across the others. So the short answer for your first question, Ricardo, will be very simple. So we at TCX, we take the FX risk. So the FX risk that lenders and borrowers do not want or could not take. So to make it very simple. If we dive or if we go into the details on the way we operate and of course the business model of the fund, so we offer, as you said in your introduction, we offer to our partners and mostly to lenders FX derivatives. So when it comes to derivatives product, for those who don't know, it's mainly cross-currency swaps and the FX forward, to use a technical jargon, but I'm sure a lot of you already know what it means. So we use that product. We offer that to the lenders for them to be able to hedge the FX risk they will take when it comes to financing project. It can be within the financial sector, it can be for energy, it can be for wealth, it can be for any kind of project they want to support on the continent. It can be for emerging and frontier market. So we offer that type of solution, allowing the project to be funded in local currency. So the purpose of the fund is to hold that risk. So we take that local currency risk, and we are, at the end of the day, we always run a net open position, meaning that if you just sum the long position with the short, you will see that the fund will take, at the end of the day, a net open the entire duration of a financing, let's say for a bank, for instance. We can say, for example, for a project that needs 5, 10, 15 years in terms of duration, in terms of maturity. So we price that risk, say X%, for example, per annum. And the way it works is very simple. So once we identify the FX risk for the entire duration of the financing, this cost of hedging will be incorporated within the interest rate of the financing for the entire duration, as I was saying. So as we all know, interest rates have increased across the globe, as I was saying in my intro, in line with the inflation outlook, where we see a lot of central banks trying to fight that phenomena, which is not an easy one. I'm sure all the central bankers across the world are quite occupied with that subject, which is not an easy one. So of course, on the FX front, this year to date, I was looking to some numbers when it comes to FX risk. Concretely, if you look at, for example, the average depreciation rate of African currency in a general, I don't want to sometimes generalize Africa, but if you just take a number, and the way to look at it is very simple, is to look at the mean, the average. You will see that around 40 to 50% depreciation rate for African currencies across the region. This is versus dollar. So it means that when you see the currency losing 15% of its value in average, because it depends. If you look at, for example, for Nigeria or Malawi, it's a different story. But in average, if you see the currency losing 15% of its value versus the dollar, just to take an example, or versus the euro, it means that someone is taking that risk somewhere. Someone is taking the hit. And to finish my introduction and my presentation of TCX, we are taking that risk. So we price that risk and we support mainly flows from developed countries into emerging and frontier market, trying to finance project where the need for local currency is crucial to support and to finance the growth of the region. So long story short, TCX risk could be, sorry, the FX risk could be mitigated by using local currency financing, and using derivative. This is something we provide at TCX, can be one of the solutions to this problem. So this will be this is the first answer to your first question, Ricardo. Answering to the second one, you are fully correct, exactly. So we conducted with the support of Making Finance Work for Africa a survey. So we have conducted this survey and analyzed the results to estimate the impact of currency risk, mostly on the financial sector, to test the financial resilience of the sector, but also to identify the barriers and ultimately to find solution to reduce that risk, the one I just explained, and the one borne by the African financial institutions. So for your information, we are still collecting data until the end of this month. So for those who did not respond, please feel free to add few data points to our survey. But however, I can share some preliminary results. So maybe I will share 4 results. First of all, and this is something maybe which will not surprise you, but it's good to put some numbers on these first findings. So we have seen that 70% of all African FIs, financial institutions, are exposed to currency risk. So I'm sure we are not surprised by this first result, but it's good to have, as I said, this number. The second finding I wanted to share with the audience is when we have asked the banks and others FIs if they had to scale back or to postpone or to cancel any funding agreement due to FX risk, the answer was positive for around 45%. So it means concretely, we have seen a lot of FIs trying to raise funding out of the domestic capital market, let's say on the international capital market. And for FX risk, some of those projects need to be stopped or postponed, and it was quite a large share of them. I have a project in mind in Cameroon for a bank who wanted to get funding from Europe. The third finding I wanted to share is still when we ask to the same FIs which solution they have to manage, which solution they will prefer if they have to manage FX risk. And of course, the first one which came was the natural hedge. Natural hedge meaning just in terms of asset and liability management, they are ready to take FX funding to finance FX loans, and vice versa if they are doing that on the other way for asset and liability management purposes. So so natural hedge was the first answer, and I will finish with my intervention with the fourth findings we have seen during this preliminary survey was again when we asked to those same FIs what will be the desired option they will like if they need to manage that FX risk. And surprisingly, I will say derivatives, the product we offer at TCX, came on top of that list. So concretely, the banks who understand the FIs globally across the region wanted to mitigate that risk, not only by using the natural hedging solution I mentioned earlier, but also entering into derivative product, meaning that they are keen to use such product we offer at TCX, trying to mitigate that risk. So I will stop here for the moment, and I leave it to you, Ricardo, for the next question if needed. Thank you very much.
Thank you very much. I mean, we'll get back on the second round for one more specific one, probably on trade finance. But thank you very much. So now I'm ending, the floor to Mr. Matu Mugu from the Central Bank of Kenya. I mean, to ask like the central bank view or the regulatory view to some of the things that Colin was showing before. I mean, so what I have like one question. I mean, we divided into two parts, right? I mean, the first one would be as your, in your role as a deputy director involved in banking supervision. I mean, what is, could you give us like a brief overview on the key trends in Kenya? And I mean, and to what extent, I mean, if you feel, from your contacts with other central banks and regulators, and also from the information that we have from the international banks based in Kenya, if these trends are relatively similar to what we see in the continent as a whole. And then the second one is more specific. I mean, so as we mentioned before, and this is not new. I mean, the pandemic did not lead to an increase in NPLs because of the action by supervisors. But actually, we see in our survey, and this is not just this year, as Colin was mentioning, but even in the previous edition, that NPLs are a main concern for the banks. I mean, so this would tell us that at some stage, or this could potentially become a problem in the future. Does the Central Bank of Kenya has any policy measures still in place to manage asset quality? And I mean, and if so, could you just give us a brief explanation about it?
Thank you, Ricardo. You can hear me?
Yes, loud and clear as well. Hello.
Great. So thank you very much, Ricardo, the EIB and the Making Finance for Africa work for inviting us this afternoon to share with you what our experiences are. And maybe to respond to your first question, I think the trends in supervision are really, what underpins them is what's going on in the banking sector. And this is, of course, not just in Kenya, but across the region and also globally. And I think Collins captured the overarching factors quite well. Looking at we have had a period of tightening. There have also been spillover effects, say from the tightening in the advanced economies and spilling over into the emerging and developing economies like Kenya. And also, Demba talked about FX. That's also a big issue across the region. But also, to answer your second question, because I can take both at the same time, I think credit risk has traditionally been what we have focused a lot on, and it remains for us a key concern, even at the moment. Of course, we also have our banks having their footprints across the region and in other countries. It may be more of a concern now in Kenya, for instance. So Kenya maybe is where it is more of a concern compared to the other countries, particularly within the East African community where our banks are operating. So we're just out of our banks. Our regional banks, what I would call our regional banks, are announcing their third quarter results. And looking at what they're announcing, we are seeing increased provisions in Kenya, but in other countries, the asset quality remains fairly stable and the level of provisioning remains stable. So credit risk remains for us. We are currently sitting at about 15.3% now. The ratio of gross non-performing loans to gross loans is about 15.3. A year ago, it was about 13.3%. So that remains of concern. But what has also become more prominent now is interest rate risk. So that's become more prominent given the rising interest rates, particularly where you have banks, and this was also covered in the presentation. Banks are fairly exposed to government securities, and they're holding these, they're available for sale in terms of their classification. So we have seen over the year an increase in mark-to-market. So there's been quite an increase in mark-to-market, what I would call losses. So taken quite a big hit. And that calls, therefore, for additional capital to cover the increased market risk. Of course, again, also the issue of foreign exchange that's been mentioned. That also has an impact also on NPLs, given that when you have the rate, the currency rate depreciating, FX loans, then that in local currency term, that increases and poses a risk to non-performing loans. But they also, of course, and this has also been covered, digitalization is now a very big factor and has increased cybersecurity risk, operational risk. So these are things we are looking at much more closely and across, and this is true across the region, that we are moving quite rapidly. If you look at particularly in East Africa, the reach of digitalization underpinned by mobile phones has been quite substantive. So that's leading to that increase. Liquidity has been also tight, fairly tight. If you look at liquidity conditions, again, when in an era of monetary policy tightening, then liquidity conditions tend to get tight, but banks have sufficient liquidity buffers to move over that. In terms of when we look at and of course, maybe later I could also speak to climate risk, which is an area that we also focused quite a lot on, but that I could speak to later. But in terms of policies, in terms of non-performing loans, I think the focus for us is to ensure that the banks have robust credit underwriting standards and they have robust credit risk management systems. And they're also making adequate provisions. We are also open to innovative ways of banks dealing with NPL resolution, so long as they manage the risk. But what we focus a lot on is to ensure that there is adequate disclosure of NPLs. They are classified, the loan book is classified appropriately, and appropriate provisions are made, because the risk you face if you don't have adequate provision is then overstating both your capital and also your earnings. So we focus a lot in both our what we call our on-site monitoring and our off-site monitoring of banks to ensure that is done. And of course, we periodically monitor. We do the same. We do credit surveys every quarter, really to understand the credit conditions, looking at credit standards, looking at prospects for NPLs. How do credit officers see this? How is demand for credit evolving? What is their stance around recovery. So that keeps us grounded in terms of seeing how the credit conditions are on an ongoing basis. So maybe I'd want to leave it there, and then could pick up subsequent questions on the next round. Thank you.
Thank you very much, Matu. Then, so for the last panelist for this first round, it's Mr. Edu Amenove. In this case, I mean, since you are now, this is like the voice of the stock exchange, so the financial markets, non-banks. My first question would be, so I mean, as you saw from Colin's presentation and from the report, in our study, we found out that banks and other institutions have some difficulties in obtaining, affordable medium and long-term financing. I mean, so there is now some issue with, especially with the longer term. What is your view in terms of what you see actually then in the local capital markets? You see that the reality mirrors the information that we received from the survey?
Thank you very much for inviting me to this webinar. I'm very happy to participate in this discussion. I would like, first of all, to congratulate EIB and Making Finance Work for Africa for this survey that is rich in terms of conclusion in what is happening in the banking sector in Africa, and particularly the good findings also on the climate finance and gender risk. For me, it is important to notice that the tightening of the monetary condition in Africa is the consequence of the situation we are suffering from the COVID pandemic to the war between Ukraine and Russia. And our central banks decided to raise interest rates because it is the only way to fight inflation, and is what happened also in our region. We saw the average interest rate of the central bank in the WAMU region raised from 2 to 4 or 5% in 1 year. But the consequence of that is that the inflation rate goes down from 8 to 4% or 3%. That is the good news for inflation on the inflation side. But on the refinancing of the banks, it is a bad news because the bank cannot go to be refinanced by the central bank at this high rates. And this has some consequences on the capital market. The first one is that the bond market goes down. The banks are not ready to continue to support the finances of the government that are issuing a bond on our market. And also, even if you don't see a very important drop in the credit, we have some consequences on the credit also. But I think that the capital market can bring solution to this situation. If the bank cannot go to the central bank to be refinanced, what we can do maybe is to see in the assets what we can do by securitization to bring them new money to support the debt market and also to support the credit appetite, as you say in the survey. For me, it is important to explore this kind of solution because it is a real solution. And the bank can use securitization first to transform the assets that are illiquid in the balance sheet to sell them to the investors so they can get new money and they can use this money to finance the government and lend to the SMEs and etc. They can do it for both the credit that they have in their balance sheet, on the commercial credit, and also on the credit that they lend in terms of real estate lending to the families, etc. So my solution is to explore with the bank the possibility to use the capital market to securitize some of the assets to fund new resources to support the debt market on the continent, and also support the credit activities. Thank you.
But then this is a nice segue to my second round of questions, and then I would start exactly by yourself, and then I'll ask you to the extent as possible to be short, and then to the other speakers as well. Is that so? Of course, I mean, so the now, as you were saying, we agree, and this is also something that we confirm from the service, that the banks can and should use more the capital markets. But one reality in Africa is that the depth of the capital markets is more shallow than it is in other regions, even in frontier markets. So in your view, what can be done, especially be it in terms of regulation, changes, to costs related with listing in stock exchanges or issuing securities? What should be say the top 3 priorities from regulators and from policymakers, basically to boost the capital markets?
Thank you very much for this question. I think that we have 2 very important things to do. On the demand side, we need to boost the long-term savings, institutional savings coming from insurance companies and pension funds. We need to have more and more pension funds and insurance companies involved in the capital market. The ratio we have actually is too low, 5% of these savings coming from the insurance companies to the market capitalization on the continent. It is too low. I think that is very important if you want to support the development of our economy for the next years. You need to make a lot of reforms to create more value in the insurance area and also for the pension fund. We also need to more use the digitalization to make more inclusion in the financial sector, so we can reach the informal savings for retailers that we are not, we don't have at this point in the capital market. With this digitalization, it is an opportunity for our banks, for our market intermediaries to go to reach these informal savings and to bring them to the market. That can also bring more resources in the market to support the development of our activities. On the other side, the offer side, for me, it is important to continue the privatization program in our countries. I am in Nairobi. I've just here the head of state of Kenya talking about 35 new companies that can be bring to the market via privatization in Kenya. That is a very good news for the Kenya market. And I think that all the African countries can do the same. We have one of our flagship operation last year in Côte d'Ivoire with the IPO of Orange Côte d'Ivoire that boosts the BRVM market capitalization around 25%. That is very important. We need to continue to have more IPOs coming in the market via privatization. The second thing we can do also is to encourage PE funds to exit by our market. We need to create favorable fiscal conditions to them. We need to encourage them. You need to sensitize them to come to the market using IPO to exit from the investment. That is, for me, very important also. Finally, we need to create more conditions to have SMEs, to have some private companies coming to the market. This can be fiscal incentives or other way to encourage them to come to the market. You cannot continue to say that African capital markets are illiquid, are not deep, if we don't do anything to change the situation. And finally, for me, it is important to support the linkage between our capital market. You know very well the AELP project that is supported by AFDB. We just today assisted to a live trade between Nairobi and the BRVM on Safaricom shares using two brokers coming from the two stock exchanges. That is a great news. I think that we need to continue to encourage this kind of operation so we can link more our capital market to have a bigger market, a deep market, a liquid market for local investors and international investors.
Thank you very much. Now I'll pass over to Demba Tenya, for a question relatively related to this, but I'll ask for it to be as concise as possible, because we are reaching the end of our webinar. Ideally, we would have some questions also from the audience. So we were, one of the things is exactly the interlinkage between the different capital markets, as now was being referred, between the Nairobi Stock Exchange and West Africa, but also something. There is also the same need in terms of effects, but for a different kind of interconnection in Africa, which is the trade interconnection. So there is the Continental Free Trade Agreement, and it's being implemented. But one of the things is just there is some shortage of trade finance across countries. To what extent, you think that these issues can be sorted, be it through liberalization of FX markets in Africa, or you think that we are not there yet?
Thank you very much, Ricardo, for the question, which is a very important one, because we always want to raise the integration in Africa. This is something which is extremely important. So the African Continental Free Trade Area initiative you mentioned is definitely a very good mean to achieve such integration. Just to give some example and actions, we can mention, for example, what the PAPS is trying to achieve. So the PAPS being the Pan-African Payment and Settlement System. So if you remember, I don't know, so for those who have seen that during around the launch of the platform, but the platform aimed to save Africa more than, I think, $5 billion equivalent annually in terms of payment transaction costs. This is a huge amount of money that is not used to finance real project, real investment that are crucial and needed in the continent. So just to be concrete again, if I am buying from west to east on the continent or from south to north, I think by the central region, we need to pay those imports. We need to settle those flows. And as of today, we mainly do that in dollars or in foreign currency. But the way to achieve also this integration, and something you mentioned, Ricardo, is connecting market, connecting people, connecting importers and exporters can be achieved by using local currency in our own continent. So it means that if I'm based in South Africa, if I want to import something from Morocco, I can pay in rand or I can pay in dirham, Moroccan dirham, sorry. So doing this kind of action, allowing economical actors, operators to deal with their own local currency will allow them to facilitate such integration. And we can, for example, give the case of the CFA franc, where we can see countries within the region from Senegal to Cote d'Ivoire exporting and importing between themselves. And the idea and the goal is to expand that to the 54 countries in the continent. And technically, when it comes to TCI expertise, which is the FX, as you know, we, as I said, we deal with FX risk. So we can, of course, facilitate such transaction from if someone want to pay, as if I just keep my example of Moroccan dirham, sorry, if someone from South Africa want to pay in Moroccan dirham, we can hedge that exposure and facilitate such payments. So just to finish on my presentation, so TCS is active across the continent. So I think it's 50, it is actually 51. We have 3 countries that we don't cover as of today, but the fund is active globally, and facilitating such payment across the continent and from country A to country B by using the own local currency will be something very crucial and useful for the future of the integration of the continent. Thank you.
Thank you very much. And now my last question in this to the panel before I go to some Q&A is then from Mr. Matumugu again. You were alluding before the green and the fact that climate risks are also taken into account by the Central Bank of Kenya. I mean, recently you've been working together actually with EIB, with us on a project to support the greening of the financial system in Kenya. Could you and then, sorry again to ask, but could you just explain this as briefly as possible? What is the aim of the work stream, and I mean, what are the main objectives that you want to achieve with this project?
So thank you, Ricardo. Yes, we are working with the European Investment Bank on the greening of the financial system project. And this is really intended to embed climate-related risk management in our banks, but not just on the risk side, but also on the opportunity side. So what we want to do is to crowd in private sector funding for Kenya has a nationally determined contributions figure of estimate of $62 billion needed until 2030, and government can only raise 54 billion, or actually 8 billion. So 54 billion needs to be raised from private sector development partners, and we want our banking system to be part of that to finance Kenya's green transition. But they need to have the know-how to do this. So there are 3 components to the project. One is we are developing a green finance taxonomy. Again, we need to be clear, what are green projects, what are green activities, so that we are all speaking from the same page. Then from the supervisory perspective, we are working on climate risk hazard mapping. And Collins talked about physical risk and transition risk, and there are also other climate-related risks. But how do those map specifically to Kenya? So that we're also able to develop stress testing scenarios from where we sit, and are able to then mitigate the climate risk or propose mitigation measures to our banks. And the third part is on disclosures. So we are enhancing our framework for disclosures on climate-related risks. So currently, there is a new standard. There are new standards that were issued by the International Sustainability Standards Board, and we are working to upgrade our disclosures framework to that those new standards. But again, also, there's a component. EIB is also working with our banks to build their technical capacity. And Collins really mentioned that one of the barriers that we have in terms of banks picking up green financing is technical skills, or the lack of in the institution. So there's a capacity building program as well that is tied to this for our banks. So in a nutshell, this is what we are doing. So the issue is to crowd in financing for Kenya's green transition.
Thank you very much. I mean, and for being concise. So we have, in theory, 5 minutes, but I think that we can expand a little bit the time for Q&A. So if those of you that want to ask some more questions, please do it in the chat room. And since we already have a few, we don't have time, then we can address them separately, either by email or by any other form in the future. Colin will have to step out from our side because of a previous commitment. But again, if there are some questions on our presentation and survey, please, just let us know. So I'm just going through what we have in the chat room. I think there is kind of a question here from Sonia Beng in terms of what is the status of the derivatives market in the continent, and to what extent, if there is an increase of the use of inflation derivatives given the current environment of increasing inflation and of course rates. So I would, probably then on this case ask Mr. Edu Amenoe if you see if from your understanding from the capital markets that there is some appetite from investors for this kind of derivatives that could be a good edge in the current environment, and also for the banks, exactly, not just for all the kinds of investors. That will be the first one, and then something that could be probably for Mr. Matu, that we have a question here. I mean, on digitalization and regulation, right? I mean, there is the assertion or the thesis that of course if banks are constrained by some lack of funding or are slower to move, fintechs can step in and can replace banks and be more agile. But regulation is probably not yet completely encouraging, or probably still in some countries more than the others. Do you still think that there is some room for more changes in regulation to increase the activity of fintechs? So first, I would perhaps ask Mr. Edo about the inflation-linked bonds or other kind of products and derivatives in the region, and then to Mr. Matu on the regulation.
Thank you. Can you hear me?
Yes.
Yes. On the derivative market, what I can say is that we have only 3 derivative markets that are active on the continent. The biggest one is on GSE. We have also Nigeria and Kenya. But we have other initiatives on the continent to create other derivative markets. The BRVM has a project on that. We will launch maybe our derivative market in 2025. And the other exchanges are considering also launching a derivative market. But I would just like to say that our derivative markets are only for equity and indexes. But for me, it is important also to create more derivatives on currency, and that can be encouraged by the central bank and also by the banks. And it is another issue to have this kind of derivatives. And I know that many of the banks have this kind of demand to have more capacity to have an arbitrage or to use some derivative instrument to cover the exchange risk. I think that is something that is important in this tough time, and then can be also bring more serenity in our capital markets.
Thank you. So then the question on the regulation and fintechs.
So thank you, Ricardo. I think there is no cookie cutter answer to this. And as you said, it actually depends from country to country. But what we are increasingly seeing is that it's not a question of banks or fintechs. It's actually, we are seeing movements towards more of ecosystems and partnerships. So that is what we now have to deal with in terms of, do we have the appropriate regulation? Not to regulate maybe in the traditional way where we are regulating by institution, but by the activity that is being provided. So I think from where we sit, it's about a changing approach to how we see this, and not looking at whether it's fintech or banking, but it's financial services. Because if you look at the ultimate customer, the ultimate customer does not care whether it's provided by a bank or a fintech, but is the service efficient, is it affordable, and is it available when I need it? So I think the challenge to us as regulators is actually to change our perception of how we look at this and look at what is the activity as opposed to looking at the institution. So that's the short answer to a very long question.
Thank you. And then one final question from the audience. And I mean, to those of you that will not have your questions answered now, we'll basically collect them and then we'll get back to you probably by writing. One question for Demba, specifically in terms of the product. So this is Martin Coswell that asked the question. To what extent does the acceptance of risk extends to supporting proof of concept projects where the clients can demonstrate or prove the economic viability of mini-grid business models? So, I mean, to what extent, basically your acceptance and managing of risks extends also to this kind of projects or just to the FX?
Thank you, Ricardo, for the question, and for Colleen. Yes. So short answer, yes, it's possible. And of course, when it comes to hedging and the cost related to that risk we are trying to mitigate, we need to incorporate or to assess that cost of hedging in light with the project or the financial model of the project we are trying to finance. And just to share some example, we have been supporting several investors across the globe investing in the mini grid and the off grid and some solar home system solutions across the continent. I have in mind some projects we supported in Malawi or recently in Kenya, for example. So of course, the key question for a developer of this kind of project will be, okay, if I know that I'm facing that risk, I know there are solutions like this one that TCX is providing, and I know the cost will be X. And then I can take this cost of hedging, put it in my model, and see what will be the outcome. Is it conducive to business? Yes or no? Is it affordable? Yes or no? So it's really basic and simple. And if the answer is yes, we can support that. So it's a good news. And if we see the cost of hedging being problematic because of not reaching the return needed on that project, there are several ways to support this kind of initiative. For example, we created a facility with the support of the European Commission, where we have been able, for example, to reduce the cost of hedging to support those kind of impactful projects.
Thank you very much. There is a question specifically in our survey. I mean, Colin, I don't think he's around now, but I can just quickly take it from Stephen Iris, which is asking regarding to the crowding out that Colin was showing, that the bank's public sector exposure is increasing, and then to the expense of reduction in private sector lending, and to what extent this decline in private sector lending is more is affecting more the SMEs. We don't get a nitty-gritty breakdown with our crowding out indicator, but in a way we get that information from the survey. I mean, when banks report the tightening standards of SMEs in most of the countries, and then when we see, then if we go to the country breakdown, that actually the interest rates to SMEs are increasing more than to big corporates. So one could say that there is some increasing or some tightening of credit conditions to SMEs at the expense of this crowding out that we are seeing, although it's not directly from our indicator. But I mean, some countries where interest rates to credit to SMEs or even to micro companies are increasing way faster than to bigger corporates. So we have more questions here in the chat. I mean, we'll address them in writing. But since we are already passing at least by 5 minutes our time, and most of us have probably other commitments, that are almost clashing with those ones. I would like to thank you, everyone, once more for your time and participation today. I mean, we're getting closer to the busiest part of the year. And especially with a warm thank you to Making Finance Work, for helping us organizing these conferences. And then, of course, even a warmer thank you to our panelists that were able to join us today. So good rest of the day to everyone. And, let's talk again soon. Thank you very much.
Thank you very much. Thank you. Bye-bye. Thank you.
Goodbye.
Thank you. Bye.
Bye.